listen to me very carefully, because I'm only going to say this once, and if you are too proud or too lazy to hear it, that is going to cost you a fortune. Right now, the market is in the middle of one of the most irrational, emotion-driven sell-offs I have seen in beaten-down quality businesses in decades. We are not talking about garbage companies. We are not talking about meme stocks or speculative garbage with no revenue and a dream. We are talking about real businesses, businesses that generate billions of dollars in free cash flow every single year, businesses that are so deeply embedded in the financial infrastructure of this country that ripping them out would cost their customers more pain than keeping them ever could. And Wall Street, in its infinite, panicking stupidity, has decided that because a word, a single word, AI, is being thrown around in every earnings call and every headline, these businesses are finished. They are not finished. They are on sale. And I am here to tell you exactly what they are worth and exactly what you need to do about it. Because time, unlike your patience, is not infinite. Now, before I go any further, if you are watching this channel and you have not yet subscribed, I want you to stop what you are doing and hit that button right now. The intelligence I'm about to hand you in this video would cost you a private consultation fee that most people could not afford. I am giving it to you for free, and all I am asking for in return is that you subscribe, so that the next time the market hands you an opportunity like this one, you are not sitting in the dark wondering what to do while smarter money moves without you. Let me explain to you what is actually happening in the market right now. Because if you do not understand the mechanism of the fear, you will keep making the same mistake that has kept ordinary investors poor for generations. The entire software as a service sector, companies that sell recurring subscription software to businesses, has been absolutely obliterated in terms of investor sentiment over the last 12 to 18 months. The reason being sold to you on every financial news channel, every podcast, and every clickbait YouTube thumbnail is artificial intelligence. The argument goes like this: AI is going to replace everything these companies do. Their software is going to be obsolete, and therefore the businesses are worth nothing. Now, I want you to think about that argument for exactly 30 seconds, because when you actually apply even a modest amount of intellectual rigor to it, it collapses immediately. The argument is not that AI might affect some of their revenue at the margins, or that AI might slow their growth rate from 15% annually down to 10%. The argument being priced into these stocks is essentially total extinction. And what I need you to understand, what separates a billionaire investor from someone who panic sells at the bottom, is that extinction and disruption are not the same thing. They have never been the same thing. When the internet arrived, people said it would kill retail. It did not kill retail. It restructured retail. When mobile arrived, people said it would kill desktop software. It did not kill desktop software. It changed how software was delivered. AI is going to change how these companies operate. It is not going to vaporize $14 billion of annual free cash flow overnight. And any investor who is pricing it as though it will is making an emotional decision, not a financial one. That emotional decision is creating your opportunity right now. And there are three specific businesses where that opportunity is most pronounced, most mathematically defensible, and most urgent. So let us go through them one by one with the numbers, not the feelings. The first business I want to talk about is Intuit, ticker symbol INTU. And I want you to understand immediately that you already know this company, whether you realize it or not. If you have ever filed your own taxes using TurboTax, you have used Intuit's product. If you have ever run a small business and kept your books in QuickBooks, you have used Intuit's product. This is not some abstract enterprise software that you have never encountered. This is a company that sits at the absolute center of how tens of millions of Americans manage their personal and business finances, and it has been doing so for decades. Now, the stock is down nearly 50% from its all-time high of $114 per share, sitting around $405 as we speak. Year to date, it is down 35%. In the last 6 months alone, it has dropped 40%. And the entire justification for that collapse, according to Wall Street, is that AI is going to replace TurboTax and QuickBooks and make the entire business model obsolete. I want you to sit with that claim for a moment. QuickBooks owns approximately 85% of the small business accounting software market in the United States. 85%. That is not a market share number that a competitor builds against over a weekend. That is not a moat that evaporates because someone releases a chatbot. The switching cost for a small business that has all of its invoices, its customer records, its payroll history, and its chart of accounts inside QuickBooks is not a financial cost, it is a logistical nightmare. Businesses that switch accounting software do not do it casually. They do it at the beginning of a new fiscal year. They do it with the help of an accountant. And most of them, when they actually price out the disruption, decide it is not worth it and stay exactly where they are. That is the definition of a sticky business, and sticky businesses are exactly what you want to own when the world feels uncertain. Now let us look at the numbers themselves, because the story is compelling, but the numbers are what will make you rich or keep you poor. Intuit generated $6.84 billion in free cash flow last year. The 5-year average was $4.83 billion. What this tells you is that the business is not just profitable, it is accelerating its profitability even as the stock has been cut in half. The market cap of this company is approximately $113 billion, and the enterprise value sits at roughly $125 billion. That $12 billion gap represents essentially their total debt load. And with last year's free cash flow of nearly $7 billion, they could theoretically retire the entirety of their debt in less than 2 years from operations alone. Now, here's the number that I find most telling, and it is the number that most retail investors completely miss because they are obsessing over the wrong metric. The price to earnings ratio, the PE on Intuit, looks like 26 times earnings. 26 sounds expensive to a lot of people, but the price to free cash flow ratio is 16.5. That is less than half of where this stock was trading at its peak, where investors were paying 40 to 50 times free cash flow. Free cash flow, not net income, is the lifeblood of a business. It is the actual cash that a company generates after it has paid for everything it needs to keep operating and growing. Net income can be massaged, manipulated, and engineered through accounting decisions. Free cash flow is real money hitting the bank account. When a business of this caliber, with this market dominance, this switching cost moat, and this cash generation ability is trading at 16.5 times free cash flow, you are no longer paying for hope. You are paying for a business at a reasonable, defensible price with significant upside if the AI apocalypse that Wall Street is pricing in does not materialize at the level they fear. And when I run the 10-year analysis at conservative assumptions, revenue growth of 5 to 11%, free cash flow margins of 28 to 32%, and an exit multiple of 18 to 24 times, minus the intrinsic value range I arrive at is $400 on the low end and $890 on the high end, with a middle estimate of $600 per share. The stock is sitting at $406 right now. You do the math. The second business is Salesforce, ticker symbol CRM. And this one requires you to understand something about how the modern corporate world actually operates before the numbers will make sense to you. If you have never worked in a large enterprise sales organization, you may not immediately recognize the name, but Salesforce is the operating system of business-to-business commerce in America. When a large company's sales team manages a pipeline of prospects, tracks their communications, sends automated follow-ups, forecasts, quarterly revenue, and builds customer relationships at scale, there's an overwhelming probability that Salesforce is a platform sitting underneath all of it. It is not a nice to have for these organizations. It is infrastructure. And just like Intuit, it has been absolutely punished by the market. The stock is down over 28% in the last 6 months alone. The narrative is identical to what we just discussed with Intuit. AI agents are going to replace human sales workflows. And if AI can do the job, why does any company need to pay for Salesforce seats? It is the same fear applied to a different product category, generating the same irrational collapse in stock price. Here's what the numbers actually say. Salesforce generated $14.5 billion in free cash flow last year. The 5-year average was $9.6 billion. Again, you are looking at a business that is growing its cash generation substantially. Even as the stock gets beaten down, the price to free cash flow ratio sits at 12.3 times. I want you to stop and actually register that number, because 12 times free cash flow for a business with a 20% 10-year revenue growth rate is the kind of valuation discrepancy that serious money pays attention to. The PE ratio based on net income is 24 times, which sounds high, but that gap between the PE and the price to free cash flow multiple tells you exactly what I told you. With Intuit, free cash flow is dramatically higher than net income, meaning the business is generating far more real cash than its accounting earnings would suggest. The profit margin has been improving dramatically as well. The 10-year average profit margin was about 10.5%. The 5-year average improved to 11.3%, and last year, the profit margin came in at 18%. That is a business that is getting leaner, more efficient, and more profitable as it scales, which is exactly what you want to see in a maturing software business that the market has decided to treat like a failing one. The revenue growth rate has been approximately 20% annually for the last decade. Yes, guidance for next year came in at 10 to 11%, which is slower than the 15%, the 5-year average, and Wall Street punished them for it. But I want you to think carefully about what it means for a business of Salesforce's size to still be growing its revenue at 10% annually at their revenue scale. 10% growth represents billions of additional dollars of recurring revenue being added to the business every single year. And that revenue comes with subscription economics, meaning once a customer is signed up, the cost of keeping them is minimal relative to the cost of acquiring them in the first place. Salesforce is also not standing still in the face of AI pressure. They have built and are actively deploying their own AI, a platform called Agentforce, which is their bet that AI makes their platform more valuable, not less valuable, by allowing their customers to automate even more of their sales and customer management workflows inside the Salesforce ecosystem. That is the right strategic move. And whether it fully succeeds or only partially succeeds, the base business generating $14.5 billion of free cash flow does not disappear because a competitor releases an AI feature. When I run the analysis at conservative assumptions, revenue growth of 5 to 10%, free cash flow margins of 25 to 35%, exit multiples of 14 to 22 times, minus the intrinsic value range I arrive at is a low of $190, a high of $520, and a middle estimate of $320. The stock is trading at roughly $240 as of when this analysis was done. On the middle and high assumptions, you are looking at substantial upside. On the low assumption, you are at break even or modest loss. When a business of this quality is priced such that your downside is modest and your upside is significant, that is the asymmetric risk profile that serious investors spend their careers trying to find. The third business is ServiceNow, ticker symbol NAONL. And I want to be direct with you. This is the stickiest of the three, and stickiness in business is worth more than almost any other quality you can name. Because stickiness means your customer cannot leave without causing themselves enormous pain. ServiceNow does not sell to consumers. You will never download it on your phone or use it to file your taxes. What ServiceNow does is manage the internal operational nervous system of the largest and most complex organizations on earth: hospitals, governments, multinational banks, and massive corporations use ServiceNow to manage their IT tickets, their HR workflows, their legal request processes, their compliance procedures, and dozens of other internal operational functions. This is not software that a company tries for a quarter and then cancels if they find something slightly better. This is software that is woven into how thousands of employees do their jobs every single day. And ripping it out is not a business decision that any rational leadership team makes lightly, because the disruption cost is enormous. The switching cost is not just financial. It is operational, it is political, and it is temporal, meaning the process of switching would take so long and cause so much internal chaos that most organizations simply do not do it unless the platform has failed them catastrophically. Now, the stock is down over 30% year to date and more than 50% from its highs in 2025. The AI fear narrative is exactly the same. AI agents will replace the workflows that ServiceNow manages, and therefore the business is obsolete. And I will grant you this much: ServiceNow is expensive at its peak valuation, and expensive stocks get hit harder when fear arrives than fairly valued stocks do, because the margin of safety was thin to begin with. But let us look at what you are actually buying at today's price. The market cap of ServiceNow is approximately $105 billion. The enterprise value is $111 billion. The difference, roughly $6 billion, represents essentially their net debt position. And ServiceNow generated $4.5 billion in free cash flow last year. What that means in practical terms is that this company could theoretically pay off its entire debt load in approximately 1.5 years of free cash flow from operations. That is extraordinary financial strength, and it is the kind of financial strength that gives a business the ability to withstand competitive pressure, invest in its own AI capabilities, and survive periods of market fear without being existentially threatened. The price to free cash flow ratio is 23 times, which is higher than Salesforce, but justified by the growth profile, because the 10-year revenue growth rate for ServiceNow has been 30% annually, 24% annually for the last 5 years, 22.5% for the last 3 years. Those are not growth rates that belong to a business. The market is pricing as though it is in decline. Those are growth rates that belong to a business that is compounding value at a rate most companies never achieve. And critically, ServiceNow has accomplished this growth while spending almost nothing on acquisitions. Over the last 5 years, they averaged $2.9 billion of free cash flow per year, and their total acquisition spending over that entire 5-year period was only $2.35 billion. Compare that to Salesforce, which spent billions acquiring Slack and other platforms. ServiceNow has grown organically, which means the growth is real, it is embedded in the product, and it is not dependent on the company continuing to make expensive external bets to maintain its trajectory. When I run the conservative analysis on ServiceNow, revenue growth of 9 to 17%, free cash flow margins of 30 to 36%, exit multiples of 16 to 22 times the intrinsic value. Range I arrive at is a low of $95, a high of $260, and a middle estimate of $160. The stock is currently trading in the range where the middle estimate implies a meaningful return, and the high estimate implies the kind of return that changes the trajectory of a portfolio. Is there risk? Of course there is risk. There is always risk. The question is whether the risk is priced appropriately. And in a business with 30% historical revenue growth, minimal debt relative to cash flow, and switching costs so high that losing a customer is a rare and painful event for that customer. The risk being priced in right now looks excessive relative to the reward being offered. Now I want to talk to you about why all three of these businesses together form a more intelligent thesis than trying to pick the single winner among them. Because this is where most individual investors make a critical strategic error. They hear about 3 opportunities. They try to identify the one best opportunity, and they concentrate all of their capital into that single bet. That is not how intelligent money manages risk. What you have with these 3 businesses is a shared thesis. The thesis that AI is going to disrupt, but not exterminate, the enterprise software sector, expressed across 3 different product categories with 3 different customer bases and 3 different competitive dynamics. Intuit dominates small business and consumer financial software. Salesforce dominates enterprise customer relationship management. ServiceNow dominates enterprise internal operations management. These are not 3 versions of the same business. They are 3 distinct expressions of the same investment thesis that deeply embedded, high switching cost software businesses with strong free cash flow generation are being mispriced by a market that is treating disruption as extinction. If you own all 3, you do not need to be right about which one survives AI pressure most effectively. You need only to be right that the entire sector is not going to zero, which is the implicit assumption embedded in the current pricing. If one of them gets disrupted more severely than you expect, the other 2 can compensate. If all 3 manage to integrate AI effectively into their platforms and retain their customer bases, which is a reasonable and historically supported outcome, given that dominant software platforms have consistently adapted to technological shifts rather than being replaced by them, then the returns across the basket are substantial. The math on margin of safety is simple. You are buying Intuit at 16.5 times free cash flow when it was trading at 40 to 50 times free cash flow 18 months ago. You are buying Salesforce at 12 times free cash flow when it has a 10-year revenue growth rate of 20%. You are buying ServiceNow with $6 billion of debt that can be retired in 18 months of operations, growing revenue at 30% annually for the last decade. These are not lottery tickets. These are businesses with real earnings, real cash flows, and real competitive moats being offered to you at prices that reflect maximum pessimism, not reasonable probability-weighted outcomes, and maximum pessimism, when it is applied to genuinely strong businesses, is historically where the best risk-adjusted returns are made. That is not a feeling. That is a pattern that has repeated itself in every major sector, rotation, and every major fear-driven sell-off in the history of modern markets. And there is no reason to believe that this time is structurally different from every time before it. I'm going to leave you with a challenge, and I want you to take it seriously, because your financial future is not a game, and it is not something you can afford to approach with the casual indifference that most people bring to it. You now have the thesis, you have the numbers, you have the intrinsic value ranges on 3 of the most beaten down, highest quality software businesses in the American market. What you do with that information is entirely up to you, and the decision you make will reveal more about your financial character than anything else you do this year. You can close this video, go back to doing whatever you were doing before, and continue sitting on the sidelines while the gap between where these businesses are priced and what they are actually worth either closes without you or proves me wrong. That is a choice, or you can do the work. You can pull up your own analysis, run your own assumptions, stress test the numbers, and make an intelligent, informed decision about whether the margin of safety in these businesses is sufficient for your own risk tolerance and investment timeline. Stop waiting for the perfect moment. The perfect moment does not exist in markets. What exists is the current price and your best estimate of intrinsic value. And right now, on at least 2 and possibly all 3 of these businesses, that gap is wide enough to be interesting, wide enough to be worth your serious attention. Go do the work. Your future self will either thank you or make excuses. And I've spent enough of my career watching people make excuses to know exactly which one is more common. Do not be common.